All right, this is the statement of cash flows for the direct method. And today we're going to take the original steps for the indirect method, that's these here, cash flow statements, and we're going to modify it to focus on the direct approach and not the indirect approach. And the direct approach, I think, has some real advantages, and you'll see them when we get done. The first thing we're going to do is we're going to take out net income. And in fact, we're going to take out everything in the operating activity section. And then we're going to compute cash from operations. In fact, this is what we're focusing on. This is really what we're going to do because we took out that net income part. And then we're going to do these three things, but focus on the direct approach. And these are modified steps. That is, we're going to do steps 1 through 5 as in the indirect method, but we're going to exclude all effects on the operating section. So anything to do with depreciation or net income, we're going to exclude that. We're going to compute cash from operations using the direct approach, and we'll start out by crossing off all non-cash and non-operating items on the income statement. We're going to adjust each remaining income statement line to make it a cash basis income statement, really for operations, by removing the effects of the balance sheet accruals and deferrals. In other words, we're going to look at the O items except for retained earnings, including adjusting the sales for change in accounts receivable, adjusting cost of goods sold for changes in inventory and accounts payable, adjusting interest expense and income tax expense for changes in related payables and deferrals. In fact, we're going to do all of the specific accounts that have specific balance sheet like items like interest payable or income tax payable or deferred taxes payable or deferred tax assets. We're going to adjust other expenses for changes in prepaid expenses and accrued expenses. And then we're going to report that cash basis income is going to be our operating activity section. We add up the three sections and check to make sure it does explain the change in cash. And then we need to make sure, once again, that we report the non-cash investing and financing activities. Let's take a quick look at the financial statements again. This is Carrera Corporation for the year ended December 31, year 2. And we have the balance sheet. This is not changed from the indirect approach. And that was the asset side. Now we're looking at the liabilities and stockholders' equity side. We were given this additional information. And now we're going to focus on the direct method. And we're going to do steps 1 through 5 as in the indirect method, but we're going to exclude all effects on the operating section. That is, this is the indirect method cash flow statement that we've already produced. If you haven't produced it, that's no problem. You can just go straight to the direct method. But if you've produced it, you want to make sure that you get rid of all of those things that are in the operating activity section, because we're going to do operating activities in a completely different way. At the same time, we're going to keep the investing and financing activities intact, and the change in cash is also going to be intact. So we're going to do steps 1 through 5 as in the indirect method. We'll check that off. Number 6 says we're going to compute cash from operations using the direct approach, and we're going to do that first by crossing off all non-cash and non-operating items on the income statement. So let's go take a look at that income statement. Non-cash items, depreciation expense, amortization expense, and non-operating, well, that loss on sale of land, that's non-operating. And so we're going to exclude that. And so what we end up with is an income statement that is basically it's operating activities that don't include depreciation and amortization. And so we can come in here and we can cross and check off the accumulated depreciation and the patents for the O part. We want to make sure all of the O parts are there. So we're going to check that, cross off the non-cash and non-operating items on the income statement. Next, we're going to adjust each of the remaining income statement lines to cash basis by removing the effects of the balance sheet accruals and deferrals, including, let's adjust sales for a change in accounts receivable. So we have sales and we had our beginning accounts receivable. Let's assume and if you assume this, you will get the right answer, that we collected the beginning accounts receivable. And that because that was sales that were made last year, but we're not collecting until this year. So our total that we could possibly have collected for sales is $1,320,000. This year's sales plus last year's accounts receivable. And then we subtract the accounts receivable at the end because we haven't collected that. And that gets us down to cash received from customers, $1,176,000. And we're going to take that and we're going to put it at the top of the cash from operating activities section as cash received from customers. So then we can put a check mark beside sales. And we can also put a check mark beside accounts receivable on the balance sheet. We've also already dealt with accumulated depreciation and patents. So now let's put a check mark there beside adjust sales for the change in accounts receivable. Now let's take a look at cost of goods sold, and we're going to adjust it for changes in inventory and changes in accounts payable. So we start with our cost of goods sold, $528,000, and we're going to adjust it to get to purchases made during the year. So first thing we're going to do is we're going to say, well, during the year, we started out with cost of goods sold, and that could include beginning inventory that we bought in a prior year. And so we're going to add that, and that gives us the, I'm sorry, we're going to we're going to subtract beginning inventory because that cost of goods sold to get down to purchases this year, that cost of goods sold does not include beginning inventory, but it should include our ending inventory. We had to purchase that this year. And so our total that we purchased this year would be $825,600. That's step number one. How much did we purchase this year? Now we know that we didn't have to pay for everything that we purchased. So now we're going to adjust purchases to the cash that we actually paid. And so we take our purchases of inventory and we're going to add the beginning accounts payable because we had to pay that. And then we're going to subtract what we haven't paid at the end of the year. And that will get us down to cash paid to suppliers, $768,000. And we're going to take that and put it in the cash from operations section. And I'm doing it in this one as a little miniature cash basis income statement. So I'm going to add up the cash basis expenses, the first one being paid to suppliers. And then we're going to go back over here on the balance sheet and we're going to check off accounts payable, and also on the balance sheet we should check off inventory changes as well. Now we're going to check off all of the O items that come up, except we don't have to worry about retained earnings. That one we just can provide a check mark to. And so when we look at retained earnings, we've got this O in here, and that is for earnings that we get, that's for closing the income summary. We can check that one off. And now we're going to focus on adjusting the interest expense and the income tax expense for changes in the related payables and deferrals. In other words, we're going to focus on the accounts without specific balance sheet balances. if we can do that. So let's take a look. We've got interest expense, 72,000. Let's, by the way, we need to check off the cost of goods sold. And now we're going to focus on the interest expense and the income taxes. First up is the interest expense. And we look on the balance sheet and there's no interest payable. There's no at the beginning of the year or at the end of the year. So we really don't have to adjust that. And we just get interest expense is equal, or cash paid for interest is equal to the interest expense. And so we can put that right in here for interest expense. Cash paid for interest expense. And then the next one, we're going to adjust income tax expense. And here, well, we assume that first we're going to pay off any payables, that is income tax payable or deferred tax payable at the beginning. And then we're going to subtract any income tax or deferred tax payables that existed at the end of the year because we haven't paid those. We didn't have any, so we get down to 16,000. Remember, deferred tax assets are prepaid assets. We didn't have any prepaid tax assets at the beginning of the year, and we didn't have any at the end. So our cash paid for income taxes is 16,000. And so we can come in here for income taxes. And now we can put a check mark here beside that. Now we're going to adjust for expenses, other expenses for changes in prepaid expenses and accrued expenses. Let's take a look. We have everything on the asset side with an O is now checked off. So we don't have to worry about the assets anymore. On the liability side, we have already checked off accounts payable and retained earnings. There was no changes in these. Those are financing activities. These are all finance. We're just worried about the O, and the only one that's left is other accrued payables. And so let's take that, and we're going to adjust our other operating expenses. First, we're going to check off the things that we just got done. Those are the interest expense and the income taxes. And we're going to focus on the other operating expenses. And we're going to say, all right, we had our other operating expenses were 80,000. We assume that we paid last year's payable first, and that's going to be an addition to cash outflow. And then we subtract what we didn't pay this year, 96,000, and it gets us down to cash outflow for operating expenses, 128,000. And we can also adjust prepaid expenses. If you had that, you would subtract the beginning prepaid expenses because they're already paid, and add the ending because they're paid by the end of the year. We didn't have any of that, so we end up with 128,000 cash paid for operating expenses. And we're going to take that and put it right here. And now we can say, all right, we have checked off all of the different lines. Now there's some subtotals we haven't checked off, like these 432, 388, 44, and 28. Those are all totals or subtotals, but we've checked off each of the individual lines. And so we can say, all right, we can come here on the balance sheet. We know the assets are already taken care of. They were here. And now we've checked off with the liabilities. And so we can go here and say, all right, we're going to report the cash basis income as the operating activities. And then we're going to compute the section totals. And we're going to report the non-cash investing and financing activities footnote if it's necessary. So we're going to check off these things. And now we're going to just add it up. And we notice, wow, it does work. And now we've shown the direct method, cash in minus cash out, and we get cash from operations. And it's easier to understand, really. Unfortunately, the direct method is not widely used in practice in the United States. So now we can check off these, And we get down to report the non-cash investing and financing activities footnote. The same facts exist, but this would be where you say bought equipment on with a note payable or something like that. There could be a lot of different non-cash investing and financing activities, things that affect investments or financing activities. We didn't have any, so we'll check that off. And that gets us back to this direct method cash flow statement. This is the direct approach. It's up here, and we left these two the same. Two different perspectives on the same thing, the direct method and the indirect method.